Julian, you've just finished talking interest rates with the team, the Access to Wealth clients. Are we on interest rates today? You're a macro markets guy. You're a, can I call you these days a freelance trader and advisor?
I think that works, Paul. Thank you.
Cool, mate. Global freelance trader and advisor. I know you're off overseas to do a bit of stuff soon, mate. What are we talking about today? We're talking about interest rates. We're talking about markets. I can see some sentiment cycles sitting up behind you, so I'm wondering what we're talking about.
Well, I thought I'd set the scene because I talk about the sentiment cycle so much that I thought I'd just have it as my backdrop now from here on in.
Yep.
So look, guys, let's head straight into this, and I think really this is a bit of an update. I'm just going to share my screen. Just give me 2 seconds to get there.
Cheers.
Yep. Okay. Right. And let's do that, and we'll do that. Here we go. So hopefully you guys can see this as we go through now. So I'm just going to. I was interested in what Alexis was saying about. I always listen, and everybody, you should listen to what Alexis is talking about. She's really wrong, by the way, for the record. So, okay, I want to talk to you initially about the stock market. For those of you that follow any of my work, both publicly and also within the group privately, you'll know that I'm a huge fan of the sentiment cycle, and I'm a huge fan of the analysis that's going on right now, pivotal moment. And you can just see if I move my head slightly over here, this bit around here. Where are we going? There. This is where we're living at the moment. Okay, we're in the disbelief phase. Okay, of the sentiment cycle. Now, when you now look at the screen that I've got in front of you, this is the S&P daily chart. Maybe we need a bit of perspective. Let's stick this up on a weekly basis. Okay, we go back a little bit further. Wow, look at that. The market had a pretty good 21, right? And also 20 as well too. I think that story's out there. You guys don't need me to talk you through that. You know exactly what's been happening. Where I'm interested in is what's going on now, because of course I don't care about yesterday, I care about tomorrow. So when I look at the sentiment cycle, when I look at the withdrawal of liquidity around the world, when I look at what's going on around the world, and we're going to have a look at a couple of really key slides for me, then there's some conclusions that we can draw. And some of those conclusions come from information. The information we're seeing at the moment is that the world is tightening, or central banks around the world are either raising rates, thinking about raising rates, talking about raising rates, or doing it, or there's a notable exception out there. And we'll maybe have a think about what that means. Maybe this time the bond market has it right, and the bond market in the US and around the world is seeing the world from a different angle, looking through the headlines of temporarily higher prices that clearly mostly have been generated by both rent increases and also the rising price of fuel around the world. When you unpick all of this, try and make sense of it. What's happening is interest rates in the very short end are rising, liquidity is tightening, central bank balance sheets are beginning to either slow down the growth or they're shrinking in absolute terms. Okay, all apart from China. We'll deal with China in a second. When you look at this chart in front of you, what I'm seeing here is I'm seeing the disbelief phase starting to unfold. I'm seeing here the subtle warning of the market. Okay, we have gone for 13 years of a bull market. We're overextended. Does that mean it's the end today? Does that mean it's the end tomorrow? I honestly can't tell you. What I'm seeing here is a wave 1, wave 2, big wave 3, corrective wave 4, and maybe we're starting something new, and it began to happen Thursday and Friday. Who knows? It would be unhelpful if the Russians decided to do something in Ukraine. What would happen to the markets? I think there hasn't been a serious war between the major powers. They don't call it a war anymore. It's called a conflict for some period of time that could go anywhere and do anything. My mind goes back to other times when you've had this, and when that has happened in the past, you've seen significant asset sell-offs in the run-up and the early days of that situation, and after then the world realizes what the outcome is going to be fairly quickly and changes its mind. All of that's in the future. What we're talking about now is the beginnings of a potential bear market in the stock market. When you think about the withdrawal of liquidity, and I'm such a big fan of liquidity, liquidity is everything. Track it, follow it, learn to love it, because when you understand that liquidity is out there and it runs the markets, you understand that the world functions on liquidity. When that is withdrawn, then the world starts to have a hiccup. I guess you could argue, what are some of the other side of things, right? What's some of the helping factors? The helping factors is that right now we have a real interest rate. That means the interest rate minus the rate of inflation of negative 5% in the United States. That's insane, right? So you can borrow money at 2. You can do anything you want with that money, providing it pays a dividend yield. And, especially if you own a dividend yield that's linked to a stock market or an equity that's inflation proofed, and you make not only inflation, but you also only have to pay back 95% of that loan over the course of the next 12 months. So this is in real terms. This is where everything gets really sexy and things get a bit screwed up. But it really does show you that that's one of the accelerators that everybody's pressing at the moment. Okay, one of the accelerators to reduce global debt to GDP ratios whilst at the same time withdrawing liquidity on the other side. That's why sometimes this can all be a bit confusing because you have mixed messages from everybody. All I care about is short-term rates are rising, liquidity is going, stock markets are responding, therefore we need to be aware. This chart of the S&P suggests to me that currently the price action, unless we break above these previous highs, is going to be corrective in nature. I'm looking for what happens when we get into this area. Do we continue to a new bear market, or do we stabilize and then run up in the period up to Easter? Who knows? I'm not sure what's going to happen. Let's watch it. Why am I excited about a couple of things? I'm excited about the gold market. Okay, on a daily chart, you can see the blue line I drew in earlier for some of the talk I gave just now. Okay, this is higher highs and higher lows, certainly higher lows, right? There's something happening in gold. For those of you that want to talk technicals in the gold market, here's one of the technicals. About 10 days ago, somebody bought the largest amount of gold for the gold ETF that has ever been bought in one day. And they followed it up the following day with another huge purchase. That was an amazing amount of tonnage, that not ounces, but tons that were bought of gold. The market did nothing for about 4 or 5 days as they tried to figure out, and the current people who they had to buy it off somebody, right? They bought it off somebody and they had to try and figure out a way. I doubt any of the dealers were carrying that much inventory as a way of trying to get it back. And then once they covered their positions from that large buyer, look what happened next. This happens time and time again. It's important when you hear this news. When you see there's a significant buyer, it doesn't mean the market's going to rally today or tomorrow or the next day. What it means is the market will do well over a period of a few days or a few weeks, right? At that point, it's really hard to find a reason for gold to go down. Nobody owns gold. Everybody, if you talk to them, think gold's a terrible investment. Volatility is too low. It's not exciting. You'll hear lots of people be reasonably negative about it, but it's broken out. So what's going on? I think this is the beginning of something. I've said this once or twice before, only to be disappointed. This is my eternal bullish case for gold. Look at this, right? It has gone nowhere for so long. I literally have, if I'd have fallen asleep, it's like a Rapunzel. It's like a child's fairy tale, right? Fall asleep for 2 years, come back, gold's the same price. Okay, so what is happening? We think there may be something breaking out. This is interesting. Shouldn't be happening. I thought stocks are going down. Thought assets around the world are starting to wobble. Why is gold going up? Well, gold's going up because somebody wants to own it. And when somebody wants to own it, when they haven't owned it before, that means the world is changing. We have to go with the change. Guys, I can talk endlessly about everything else. I just want to show you two more charts that I was going to talk to just earlier. Let me just pull this up, just main screen this, just bear with me for 2 seconds while I muck around here and kill the presenter view and get this. Hopefully you can see this. Courtesy of Alhambra Investments. This is a chart which is very interesting. Okay, this is the imports of iron ore and commodities and other related commodities into China. What is going on? Okay, both iron ore prices are collapsing, and for the record, volumes are actually falling as well too. Look at this, prices and volumes both falling. That is not a bullish sign for the next 6 months. When you look at, we'll come out of this, when we look at the Baltic Dry Index, for those of you who don't know what I'm talking about, because I'll put this up here, I can't even do it on a bar chart, it doesn't trade every day. What it is I put up a line chart here, they just have a closing price. Well, that doesn't look very good, but it's recovered a little bit recently, hasn't it? Yeah. Now go look at this, right? Do you remember all those supply shortages we have? Everybody's complaining about how much those containers are costing. Well, look at what's happening to dry freight rates. So from the high of 5,600, we're now back to the same price of when? What? 2021? No, not just 2021, 2020. Oh, hang on a second. 2019. Oh, hang on a second. No, 2018. How far do we have to go back? We have literally got back to the old prices for dry freight rates. What does that mean? You're shipping things like timber and things like that. Rates have come off, right? Forward rates have come off. Now, why would that be happening? Perhaps all those problems that we've been seeing in the supply chains are all resolving themselves. Maersk came out this week and said that volumes, they do not expect volumes for this year to be higher than they were last year. In fact, they expect them to be modestly lower. Okay, volumes to be lower. Well, in terms of pricing, you can probably expect, given they've made something like another, I think Maersk alone made 500,000 extra containers this year. At some point in time, those containers will come onto the market. At some point in time, somebody will ship them for any old price, right? So I see all of this inventory overhang being cleared. I see all these things happening. I think there's going to be some interesting problems cropping up in the market and the world. And I think overall, the key thing that's happening is the interest rate market has got this right. Okay, what it's saying here, long-term interest rates, despite what you read in the press, despite what you hear about the Fed, despite what you hear everywhere else, right? Long-term interest rates are lower than they were a year ago. Lower, not higher, but lower. Okay, the 10-year rate is slightly higher. The 30-year interest rate is slightly lower. And the 2-year interest rate is crazy high. The yield curve has literally flattened like crazy. That's normally a good sign, right? But only a good sign when you have normal interest rates. Trust me, guys, 2% is not a normal interest rate. This is not good. So two things that I'm not happy about at the moment. One, a flat yield curve is not good for the economic prospects going forward. Secondly, because it may invert. Secondly, on top of that, the absolute level of interest rates is way, way, way too low with inflation where it is. So what is that telling you? Who's right? Is the bond market right or are the inflationistas right? I live by my old experiences of what I did for a living. I'm going, the bond market's got it right. It's seeing what's going on in China. It's seeing what's going on in supply chains. The economies are slowing. Is the Fed raising rates into an economic slowdown? It looks like that's about to be what's taking place. Guys, that's it for me. I hope you got the message. It's exciting. We're going to have a crazy, crazy 6 to 9 months. How much fun are we going to have and how much money are we going to make trading our way through that?
All right, Julian, very much looking forward to seeing that come out. These are markets. It's exciting times as the world looks to correct post-COVID. Stagflation coming. These are some interesting pieces coming in.
No, go and look what stagflation means. Stagflation means inflation without growth. You guys got to be crazy. Okay, no, there's either going to be growth or there's not going to be any growth whatsoever, right? I mean, like whatsoever. Okay, so inflation and growth will both fall back very quickly. So no, stagflation is very low growth and very high inflation. We're not entering that environment, different environment.
Interest rates are telling us, Julian, that this inflation may be short-term, maybe 6 to 18 months, that full employment around the world might also have a few issues, not saying we're heading for 20% unemployment, but we might see some growth. These are the kind of things we're expecting to see. We're expecting to see transitory markets, aren't we? Markets are going to change in the next 12 to 18 months, right?
Yeah, totally. Look, this is a different world, right? For those of you who have been following the US stock markets and asset prices in generally quite closely, the bear market started about 12 months ago. Okay, it just hasn't reflected in some of the indexes. It's only recently that the indexes have started to struggle. But if you go back and look at what's happened in crikey, you can name them, right? What's happened in some of the Nasdaq stocks, the off the run stocks has been crazy. There's been losses of up to 80%. Go and look at ARK, good old Cathy Wood's fund. That peaked out at 160. Now it's 75, right? That to me is a bit more than a small correction, right? That to me is a mare. So you've got a lot of things happening in here, right? So I meant nightmare, obviously, no reference to finger. So, but it's just absolutely crazy things going on here that are happening underneath the surface about the way in which some assets are being repriced as we speak. And I don't think we're over yet. I think there's a bit more to come.
Mate, it's interesting. Nasdaq and S&P both look to me like double top Thursdays, and they look as bearish as I've seen them for a while. And next support after the previous lows on them aren't that close. So it'll be interesting to see if we do push through. I think we'll see how this all plays out, mate. As you say, well, the traders are funny, right? Because the first thing they do is they say we need volatility. But when they get it, they'll get scared of it, right? But this is what we do. When markets move, we can make some money.
Look, this is opportunity, right? Volatility creates opportunity. What happens is you decrease your time frames and you trade on a lower time frame because you then have the opportunity to make money quicker, right? And that's why volatility is so much fun. It's much more boring to make money over the course of 3 weeks than it is to make it over the course of 3 hours. Okay, so that's why the volatility picks up. We get really excited as traders because we can make money quickly. You know, I guess you could argue we could lose money quickly, but we don't do it that way, right? Because we know we always make money because that's what we do and that's what we're good at and that's why we're here, right? So that's the object of the exercise. It just means that we have to spend less time in the markets concentrating and less of our working capital spent sweating it out on overnight closes and things like that when we can't see what's going on. We can do it all on the same day.
Mate, thank you very much for coming in. Lloyd got stuck in a bit of I understand the weather in Singapore is not lovely today. I've got to say the weather in New Zealand is not that lovely today either.
I'm amazed at everybody. I am amazed that Paul is even here today, that his house hasn't actually blown over.
Mate, I literally picked up trees off my driveway.
We had a tropical cyclone come through Wellington today. In Auckland, the bins moved across my driveway. That's the definition of a really strong windy day. Paul might have a slightly different definition.
Yes. I literally moved trees off my driveway this morning. Mate, thank you very much for your piece. Great to have you and great to have great numbers in the show today. This could well be record numbers for the last 2 or 3 years in the show. Good to see the new format really taking place. Look forward to having you back. I know you're back doing another piece for Actions 12th next Sunday. Back about a month from now doing your part for the student, the Actions 12th exclusive students one you did today. Thank you very much for that. For those that joined us today, I hope you got something out of it. It's interesting to see the different perspectives that Ash, Alexis and Julian, all fundamental based people to some degree, bring to the market and what they're looking at for the week. I hope you can use it to make some money. Stay calm. Opportunity is knocking for us. It's now a matter of staying calm and executing well to make some money from it. See you